This strategy is not only simple, but it might be the most effective way to trade on the 15-minute chart, especially if you're looking for consistency and precision. Let's dive deeper into why this method works so well and how you can use it to take your trades to the next level. First, we need to configure our indicators properly. The first indicator we'll work with is highly customizable, which is key to adapting to different market conditions. So go to the settings, and the first thing we want to do is set the signal mode to contrarian and exits. Now this is important because contrarian signals can help you catch reversals before most traders even spot them. By pairing this with exit signals, you're given early warnings of potential shifts in market momentum, which helps you fine-tune your entry and exit points. Next, we adjust the sensitivity. You want to set it to the optimal value, which is displayed on the indicator's dashboard. This setting is crucial because it tailors the indicator's behavior to the specific market you're trading, filtering out noise and giving you cleaner signals. Keep in mind that markets can be very noisy, especially on smaller time frames like the 15-minute chart. So this adjustment ensures you're not entering too early or too late. For the candle coloring, set it to none. This might seem counterintuitive at first, but by removing the distraction of colored candles, you can focus solely on the indicator signals and price action. This minimalistic approach helps you see the big picture without getting overwhelmed by too many visual cues. Now, disable the Smart Trail feature. While the Smart Trail can be useful in some contexts, in this strategy, we want to rely on the reversal bands instead. So go ahead and enable the reversal bands. These bands act as dynamic support and resistance levels, helping you identify key reversal points in the market. The bands work best in volatile markets where price tends to bounce between support and resistance, and that's exactly what we're targeting with this strategy. Once you have the first indicator set up, it's time to move on to the second one. This indicator is all about highlighting fair value gaps, which are crucial areas in the market where price is likely to return before continuing its move. So in the settings of the second indicator, disable everything except for the fair value gaps. These gaps represent inefficiencies in the market where buying and selling weren't balanced, and they often act as magnets for price. It's important to use a higher time frame for this indicator because it provides a more significant perspective on where these gaps exist. For example, if you're trading on the 15-minute chart, you might want to use the 1-hour chart to spot these gaps. The reason we use a higher time frame is that it helps you avoid false signals and gives you more reliable zones of interest. Alternatively, if you're trading on the 5-minute chart, set the indicator to pull data from the 30-minute time frame. Now, let's take a look at an example trade setup. At this specific candlestick, something very interesting happens. First, you can clearly see a buy signal from the first indicator, and at the same time, price action is filling in a fair value gap that was left behind. But there's more. Price also bounces off the lower reversal band, which is an additional confirmation that the market is likely to reverse and head higher. And if you check the indicator's dashboard at this moment, you'll notice something else. It shows a bullish trend strength. This means the current market momentum is heavily in your favor, giving you even more confidence to enter a buy trade. So with all these bullish confluences lining up, the buy signal, the fair value gap being filled, the bounce off the reversal band, and the bullish trend strength, this is the perfect moment to place your trade. Now, here's how you want to manage this position. First, you want to set your stop loss using the fair value gap. This gives you a precise level to place your stop, ensuring you're protecting your capital while still giving the trade room to breathe. Next, once the price moves in your favor and approaches a bearish fair value gap, it's a good idea to take some profits off the table. In this case, you would close half of your position at this level. By doing this, you secure some gains while still keeping the trade alive. At this point, you also want to set your stop loss to break even. This means that even if the market reverses against you, you won't lose any of the remaining position. Now, you can let the rest of your trade run. The key here is to allow the market to move naturally without panicking and closing too early. You'll hold this position until price action reaches the middle of the upper reversal band. This is a reliable point to fully exit the trade, as it often signifies exhaustion of the bullish move. If you're excited about this strategy, I encourage you to try it out for yourself. LuxAlgo's premium indicators are a game changer, and you can access them through the link in my video description. Don't forget to like, subscribe, and comment if you found this video helpful. Happy trading!